I deal in the world of risk reward. There's a 500-year history of asset bubbles, well documented in a book that you had some issues with, The Price of Time. And basically, it documents, and I had already known this about the last 100 years, but it's going on for 500 years. Every time you've had a significant asset bubble, economic trouble lay ahead. But yeah, when you had 11 years of free money, people do stupid things. All you have to do is look it up there. About the stupidest is somebody paid $80 billion for Dogecoin, which was invented as a joke. I mean, that can only happen in the world of free money. It also suppressed people worrying about the kind of stuff I just talked about 2 or 3 minutes ago, because you keep rates at zero. But the fact that this was arguably the most disruptive economic period we've had since the late 1800s, and there were no bankruptcies, apparently they've started in the last few weeks, tells me there's a lot of stuff under the hood when you go from this kind of environment, the biggest, broadest asset bubble ever, and then you jack rates up 500 basis points in a year. I think the probabilities would suggest that Silicon Valley banks, Bed Bath & Beyond, they're probably the tip of the iceberg.
The stock market bubble of the 1920s, the dot-com bubble of the 1990s, and the real estate bubble of the 2000s were asset bubbles followed by hard times. Druckenmiller thinks that the easy availability of money has created a big issue for our economy, and we haven't seen the worst of it yet. We've had a few companies go bankrupt when the free money flow stopped, but not as many as we might normally expect based on history. But what's going to happen next?
I could see corporate profits down 20 to 30%. Normally, I would say 40 or 50 in a hard landing, but this recession is so anticipated. I don't think a lot of corporations are going to be caught with their pants down, which is how normally you lose a lot of money, is you're not prepared for something that happens. Commercial real estate, you know, I'm not informing anybody in this room of something I don't know, but office is a problem. It would have been a problem anyway, but change of lifestyle and COVID makes it an even bigger problem. Financing rates going up make it a problem. I'm worried about credit tightening the next 6 to 9 months. Obviously, the banks are going into an economic period that if, in fact, we get a recession, their balance sheets are already impaired, not from where they usually lose money, which is loans, from the fact that the Fed convinced them that they're going to keep rates to zero until 24. So they bought a bunch of treasuries yielding 1 or 2%, and now they're carrying them at 5. So their balance sheets are impaired. But if we get in a recession, then the real losses comes, which is stuff like credit cards, commercial real estate, that kind of stuff. So those would be my worries.
Banking is basically the backbone of the economy. Banks make most of their profits on interest income, so the slowing of sectors like commercial real estate can cause them a lot of trouble because they will earn less on these loans, which will lead them to make less profits. It adds even more pressure to the banks that most of them put significant amounts of money into long-term US Treasuries on lower interest rates. All of this already makes their balance sheet weak enough. But if we get into a recession and people will get behind on the repayment of their loans, it can be disastrous for the banks and for the economy.
A lot of people, because we haven't had an economic decline start yet, have changed their forecast from a hard landing to a soft landing, and a lot of others have changed it from soft landing to no landing. I haven't changed mine at all. The fact that it hasn't happened yet doesn't change the probability, if it does happen, of the depth of it. I mean, basically, $10 trillion, $5 trillion monetary, $5 trillion fiscal was put in during COVID. What has happened is that created this giant stock of liquidity. I think Jamie Dimon said a couple years ago there were $2.5 trillion excess demand deposits. We've been working that liquidity off slowly. That liquidity shrink was interrupted when Bank of Japan changed YCC. They went in and they bought $400 billion worth of bonds to defend their bond market. Very odd situation. They raised rates, but then liquidity exploded on it. And then obviously the debt ceiling. Secretary Yellen drew down the TGA, that's basically the Treasury savings account, from $700 billion to practically nothing last week. That also ended up in non-issuance of government debt, so that was a big boost to liquidity. All that is set to change now. Actually, the TGA is going to go the other way. She's already stated she wants to build it back up to normal levels, so you're going to have probably about $800 billion in treasuries issued between now and year end. The Fed will be continuing on with QT. You've got the student loan thing, which I think has kept consumption up. That's all changing in September. They're going to have to actually, God forbid, in the United States, somebody actually pays interest on a loan. So to me, the probabilities haven't changed. It's been pushed out relative to expectations, but in no way does the fact that it hasn't started yet change the probability of whether it's going to be hard or soft. I would actually argue, since it's taken so long, the Fed has ended up with a higher terminal rate. And in fact, inflation gets stickier the longer it stays in the system, that it increases, not decreases, the probability of a hard landing. By the way, after the 87 crash, I was convinced we're going to have depression. So I've been wrong before, and if I'm wrong on this, I'll adjust. But I have to weigh the probabilities and do what I do with my process, and right now, that's where we are.
And when?
I think September is the first time when I was sort of afraid of booming economy inflation guy to I'm more worried about growth than I am about inflation. And originally I was fourth quarter of 23. I temporarily maybe lost my mind, or maybe I was right when the Silicon Valley thing happened and got anecdotals and stuff that has traditionally led, like trucks and retail, move that up to now. I think I'm probably wrong, and I'm going to go back to the end of 23. But the real answer is I don't know.
So recession or no recession, though, one thing that's interesting, and you included, a lot of people are very encouraged by certain areas of the market, particularly the AI boom.
There's always stuff to do. We had a hard landing in 74, 75, and chemicals and oils and that stuff did great. I'm sorry, go ahead and answer your question.
Well, do you think that all of AI makes it through this recession, or do you think that some areas of the market, particularly in AI, start to look like they're in bubble territory?
Well, all of AI is not going to make it through whether we have a recession or not, because they haven't separated the wheat from the chaff yet. But I do believe, unlike crypto, I think AI is real. It could be as transformative as the internet. It's a huge thing. And I think I've argued publicly that if staples can go up in price in a recession, why can't a company like Nvidia, if their orders and earnings go up 70% in a hard landing, which is what I think would probably happen, it's not clear that Nvidia goes down despite the lofty valuation level. History has proved if you have very good earnings in a recession and they're sustainable, if they're not, the market somehow figures it out, those stocks will do just fine. So we have some longs, we have some shorts, and the AIs have sort of dominated the long portfolio for 5 or 6 months.
It was interesting to me that Druckenmiller said AI will possibly be as disruptive as the internet was. If you take a look at his portfolio, he holds about $500 million worth of Nvidia stock, which is the clear winner of the AI boom so far. Most of the potential billion or trillion-dollar AI companies do not even exist yet, but it's safe to assume that Nvidia is the best bet if you want to get into AI. Druckenmiller also owns about $300 million worth of Microsoft stock, which can also be a nice AI play.
How do you think about going short in this market?
Our shorts have been fine this year, except my index shorts, which have been a disaster. But we always short the same way. I just try and look at the current situation, and then I try and think of a situation 12 to 18 months from now based on my forecasts. And I think if I think the security prices are going to be less, then I short them. frankly, I'm not sure I've ever made money. If I took back the last 40 years, I'm afraid to look. I've never had a down year, but I'm not sure I've made money in shorts. I like it, it's fun, but you can get your head handed to you.
So, to summarize what he said, he still thinks hard landing is more than likely. The longer the inflation stays around, the stickier it gets, so we should be conscious about this. But as a severe recession has been talked about for the last few years, most of the companies are prepared for one, which can make the effect lighter. AI is a huge thing, and if you have a company that can produce strong earnings in a recession in a sustainable way like Nvidia does, then it's not that crazy to think that even $1 trillion valuation is valid. Last but not least, shorting can be a very dangerous game that most people should not play.